Hello investor, throughout the long history of the stock market, finding undervalued stocks has been one of the time-honored ways to outperform the market over the long term. It's an approach involving buying stock in solid companies that are lower priced compared to their major competitors. When the market eventually discovers the companies undervalued, the returns can be spectacular. Ready to learn how to find undervalued stocks? Let's get going. Here are 5 ways to find undervalued stocks. Number 1. Price-earnings ratio, PA. Number 2. High dividend yield. Number 3. Low market-to-book ratio. Number 4. Low price-to-earnings growth ratio, PEG. Number 5. Other metrics to consider. Price-earnings ratio, PA. PA ratio is the typical starting point to evaluate any stock you're considering buying. PA ratio measures the market price of a stock compared to company profits, or earnings. For example, if a company has earnings of $2 per share, and its stock is trading at $50, its PA ratio is $25.50 divided by $2. So let's say you find a company in a particular industry that has a PA ratio of 15, but its major competitors are at 25. This can be a basic indicator that the company stock may be undervalued. High dividend yield. The dividend yield is the dollar amount of the annual dividend divided by the share price of a stock. If the dividend yield on a stock is $3, and the stock is trading at $100 per share, the dividend yield is 3%. If the average dividend for companies engaged in the same industry is 4%, the company's 3% dividend yield is low for the industry group. But if the average for the industry is 2%, the company is displaying a high dividend yield. If the high dividend yield has been consistent for several years, and the company has a solid track record of growing its earnings, the high dividend yield can be an indication of an undervalued stock. This can be especially true if the company also has a low PA ratio in comparison with its major competitors. Low market-to-book ratio. This is the total market capitalization of the company's stock divided by its shareholder equity. If this number is low, it can indicate the stock price is low relative to the net worth of the company. Low price-to-earnings growth ratio, PEG. This ratio is a bit more complicated than the others. It's calculated by dividing the PA ratio by the company's earnings growth rate. For example, if the company has a PA ratio of 15, and a projected growth rate of 20%, the PEG will be 0.75%, which is 15 divided by 20. In general, if the PEG is less than 1, which it is in the above example, the stock may be undervalued. Other metrics to consider. While the ratios above can allow you to compare one company with another, there are even more general metrics to take into consideration. One is the company's revenue growth, particularly over the past 2 or 3 years. If the company's major competitors are averaging 15% in annual revenue growth, but the company you're considering is averaging 20%, it's growing faster than the industry average. Equally important is earnings growth because that indicates the company is increasing its profits commensurate with rising revenue. Once again, if a company you're investigating is seeing annual earnings growth of 15% over the past 2 or 3 years, and the industry average is 10%, the company's profits are growing faster than its competitors. Though there's no guarantee, the likelihood is at some point the general investment community will come to recognize the faster growth the company is enjoying. Once they do, the stock price is likely to increase faster than the average for the industry. Please do not forget to like, share and subscribe to our channel. I wish you great and successful investment journey. Thank you.